there. Welcome to Invest Wisely, your ultimate gateway to prudent investing. I'm your host, Leela Rao. Coming up in this session, finding those hidden fees and costs in your portfolio. Can you believe that 100,000 is equal to 94,250 even before it is invested? Yes, not for a math class, but this happens almost all the time in your investment portfolio. Following that, asset allocation, the measured way to diversification. Do you know you could lose a big chunk of your principal by not having the right portfolio to suit your risk profile? We will see a disciplined way to diversification that holds good in various economic scenarios. And finally, in question time, we will discuss some of the interesting emails. Investment world is at times a financial maze of twists and turns, leading you through some blind alleys before reaching the final point. Our final point is how the invested funds grow and at what cost. Even as it is, the recent recession and market collapse has depreciated the investment accounts of several investors. This was not just because the stock market has wiped off its gains in the last 10 years, but also mainly due to poor investment decisions or improper guidance. As an investor, you must get proper guidance and management of your assets more during tough times in the market than when the going is good. It is common practice for financial advisors and investment planners to be tied to a mutual fund company or a larger investment bank. In this situation, they would offer to diversify your portfolio by investing it in a cluster of mutual funds they are tied to. In return for carrying out your investment plan, you would have agreed to pay an advisory fee which normally shows up in the invoice you receive. But there are many fees and costs that are not disclosed here. Now let us see how we can find them. We will use an investment amount of 100,000 to show how some of these costs can affect your portfolio. We are entering a caution zone, and I would strongly suggest that you have a pen and paper handy to note down the pointers to these hidden fees and costs. The first of this fee is a sales charge or front-end load, and this goes to the brokers that sell the fund's shares, or if the person is your financial advisor or planner who bought this fund for your portfolio, the fee would go to him. Let us take our investment amount 100,000. If you or your financial advisor or planner decides to invest it in a mutual fund with 5.75% front-end load, 5,750 sales load will be deducted right at the onset as an upfront charge, and only 94,250 will be invested in the mutual fund shares for you. If you're investing through a 401k or any other retirement plan through an advisor who uses mutual funds with a front-end load, every time you or your employer makes a contribution, you are charged the front-end load. The advisor makes money on a continuous basis. Of course, it is no consolation that NASD rules allow a charge of up to 8.5% front-end load on your investment. Now, there is another type of charge that is deducted from your investment when you sell the fund shares, and this is called deferred sales charge or back-end load. And this fee as well goes to the brokers or financial advisors who sell the fund's shares. Let us assume a deferred sales charge of, say, 6.25%. If your 100,000 had grown to 110,000 and your advisor decides to sell the shares of the fund, 6,250, which is 6.25% of the initial amount of your investment, will be deducted from your assets, and only 103,750 will be available to you. Now, another scenario is, if your investment had gone down to 50,000 from 100,000, like many of the investors had done during this recession, you will still have to pay 6,250 here. You will only receive 43,750. So let us get this clear. If the fund has a deferred sales charge, irrespective of the fact whether your investment appreciated or it depreciated, you will have to pay it. At your cost, your broker or advisor will make effortless money. Some funds charge you back-end load on the final amount of the time of sale. There is another type of back-end load sales charge known as contingent deferred sales load, and if a fund has this type of load, you will have to hold the fund for a set number of years for the charge to decrease to zero. Some investors are stuck with a bad investment in order to avoid these charges. But tell me, should you be penny wise and pound foolish? It is better to get out of a badly managed fund as soon as possible and put your money to use elsewhere. Now let's see what redemption fee means. This is charged when the shareholders sell or redeem shares of the fund. Unlike a deferred sales load, a redemption fee is paid to the fund and not to a broker. Typically, a fund can charge you up to 2% redemption fee. Coming back to our investment amount of $100,000, if you had already paid 5.75% as a front-end load and the fund has another 2% redemption fee, then your total charge would be $5,750 plus $2,000, which equals $7,750. Let us now look at some important ongoing expenses your account is charged. Management fee. This is paid out of fund assets to the fund's investment advisor for investment portfolio management. This is an annual fee charged to your portfolio on top of the advisory fee you pay. Coming back to our amount of $100,000, if your assets are invested in a fund that has a management fee of 0.8%, $800 will be charged to your account every year. Now, if your fund had a front-end load as well of 5.75%, then your out-of-pocket cost would be $5,750 plus $800, of which $800 is an ongoing cost and $5,750 is a one-off cost. Then we have the 12B1 fees, also called distribution fees, which is paid out of the fund's assets. This includes fees to compensate brokers and others who sell fund shares and to pay for advertising, printing, and mailing of prospectus to new investors. All these expenses go out of your investment as an ongoing annual cost. Continuing with our example of $100,000, say if the fund had a 0.25% 12B1 fee, then you will pay another $250 on an ongoing basis. So $800 for the management fee and $250 for the distribution fee will add up to a total of $1,050, which is charged to your account every year. And this represents 1.05% fee on your total investment on top of the advisory fee. This amount will vary depending upon the size of your investment. So when you see any appreciation in your investment portfolio, it is only after all these hidden fees and costs have been deducted. And mind you, even if your investment had depreciated over 30%, like many investors suffered during this market collapse, you still had been charged all these fees and costs. Trust me, these costs tend to increase your time to retirement by several years. I strongly urge you to go over your investment statement thoroughly and also visit the following websites shown on the screen. The first one here gives you a complete information on the various fees and costs involved in mutual fund investing. This other website here helps you to work out the costs and fees on any mutual fund. You could then compare it with the invoice you receive from your financial advisor. There are hundreds of no-load mutual funds that are 5-star rated by Morningstar. By visiting the website www.morningstar.com, you could check the expenses and costs on any mutual fund and also get information on their strategy and style to see if they suit your risk tolerance. Of course, A competent professional investment manager who does not have a vested interest could choose the right funds for you to meet your long-term goals. Mutual fund investing indeed gives you diversification if you have a small portfolio. But if you are in a position to make a larger investment, you are better off engaging a well-qualified portfolio manager who can create a portfolio of stocks and bonds that fits your risk and return profile. This way, you would only be paying an agreed upon management fee and can avoid all these unnecessary hidden fees and costs. When talking about diversification, we have all heard people say, don't put all your eggs into one basket. But do you know that strategic way of diversification is asset allocation? Coming up after the break is an interesting and useful overview of how asset allocation is a measured way to diversification. Stay tuned, don't go away.